Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Friday, and some people might be sitting back to relax, but we have got a jam-packed show for you today. We've got a great conversation for you with Josh Wolfe of Lux Capital that we are excited to get to. We've got a big scoop about Snap and how it is thinking about financing its very expensive investments into AR glasses. I always wanted to do that. We are also taking you inside a story that we recently published about how OpenAI is relying on data from Google searches. And finally, we are taking you through everything you need to know about software earnings season, which officially has kicked off. Now, before we begin, I want to highlight two important stories that we published in the last 24 hours that are really making headlines. Last night, the information reported that NVIDIA has told some of its suppliers to suspend production related to its H20 chip. A reminder, this is the chip that the Trump administration greenlit NVIDIA to sell in China. Our Asia Bureau previously reported that China's government had told local tech companies to stop buying NVIDIA chips because of potential security concerns, and so evidently that may be having an impact. This was a major story that moved markets. We saw share prices of chip companies in Asia moving up today, presumably because it could mean more business for them if China-based companies aren't buying from NVIDIA. I will link that story in our show notes. I definitely recommend it. The other big story that we had last night was a scoop that Meta has signed a $10 billion cloud deal with Google. It is one of the largest known agreements in Google Cloud's 17-year history, according to our reporting. And of course, this is an interesting deal because Meta and Google are rivals, not just in the AI race, but also in the business of advertising. And yet, Meta clearly still relies on Google Cloud for a lot of its infrastructure. There is a lot more to that story, and I do recommend you add that to your weekend reading. Okay, let's talk about Snap. Snap has been on a roller coaster ride as a public company, and there are few signs that ride is about to get any less dramatic. The company is betting the future of its business on augmented reality spectacles, and my colleagues at The Information broke the news this morning, that the company is considering raising outside funding for that highly capital-intensive effort. I want to bring on Kaya Yurieff, our creator economy team leader who worked on that story, and I also want to bring on our co-executive editor, Martin Peers, who, let's just say, has some thoughts on Snap as a whole. Kaya and Martin, it's great to have you here. Kaya, I want to start with you. Why is Snap looking to raise outside money for their AR glasses?
Yeah, well, how fun to be on here with Martin. Thanks for having us, Akash. I mean, the bottom line is AR glasses are super expensive, and they're going against really deep-pocketed rivals like Meta. I will say these are early stages. Snapchat has not yet, gone forward with the formal fundraising process to line up investors, but they are considering different options. Of course, the more nuclear option is totally spinning off spectacles, which the company says for now that they see kind of their free cash flow as the most capital efficient way, but they could go the route of what Alphabet did with Waymo. It's robotaxi. They raised outside funding there.
You call it the nuclear option, spinning it off. Why is that a nuclear option?
Well, because they're betting the future of Snap on spectacles being successful. So kind of decoupling that from the core Snapchat app, I think, would obviously be a big deal.
Right. And let's talk about the core Snapchat app. I mean, social media is kind of the core business that Snap has always pitched itself on. How is that business and its advertising business doing right now?
I mean, it's really slowed down in terms of growth. Q2 was a tough quarter for Snapchat, and it really stood out. They had about 4% growth in the advertising business at a time when Meta and YouTube, which have much bigger ad businesses, saw double-digit growth. But it wasn't just this quarter. We've seen really a slowdown recently with their business.
And this is because of the Snap platform as a whole. It's not attracting as many advertisers. This is not an advertising-wide problem.
I mean, the advertising landscape is really still dominated by, Google and Meta, and advertisers are not seeing Snap as a must buy in the same way as the other bigger platforms.
Martin, let's zoom out of here a bit. I mean, we were talking this morning. Snap is trading at $7 right now. It used to be at one point trading higher than $80. It's actually down 30% in the last month alone. Why should anyone buy shares of Snap right now? I mean, to talk about
No one should buy shares in this company. And I would also say that no one should invest in Evan's spectacles venture. I mean, Evan has proved himself, since he took the company public and maybe even before that, as somebody who runs the company entirely for his own benefit. He's sold more than $1 billion worth of stock since he's taken the company public. He is the only person who's actually made any money in that time. The stock is now trading at less than half where it went public. And he runs the company as though it's his own private fiefdom. And you have to remember, public market investors who buy this stock don't have a single voting right. The only person who has votes is him and his co-founder. I mean, this is purely a private vanity project, and I wouldn't suggest a single person invest with him.
And just put it into context for people who don't follow voting shares, super voting shares, et cetera. Is it common for one person, the founder, to have that much say in the company?
It's not uncommon for companies to have dual classes where the public investors have one vote and the founders maybe have more than one vote, so they can control things. In this case, public investors don't have any votes. And so it's just that there's no point buying into this stock. I mean, Evan has made the point that if you don't believe in the vision of his, then you shouldn't buy the stock. And I think he's absolutely right. But I also think that Evan shouldn't run this as a public company. He should find the backing to take it private, and then he can do with it whatever he wants.
And Kaya, this is something that he actually told you at the latest Creator Economy Summit. I mean, he basically said, hey, if you're not along for the ride, sell the shares. It's fine.
Yeah, I mean, that's exactly what he said. He was very blunt about it and said that people have.
And what did he tell you about sort of his vision for spectacles as a whole? I mean, you talked about it with him.
Yeah, we had a very wide-ranging conversation, and we spent quite a bit of time on spectacles. It's obviously something he is laser focused on and very passionate about and believes is kind of the new way that people are going to, instead of us looking at our phones or computers, that he really believes in the future of AR glasses. And he acknowledged it's an expensive bet, but his sort of argument and the argument of Snap is that now that Meta and all these other companies are coming into the space, this sort of is, they're taking a victory lap that they made the right bet 11 years ago by working on this, because now they have all this competition and they feel like they have a head start on the technology because they have been working on it for so long. And I asked him, at some point, does this just become too expensive where you walk away? And he sort of gave that response of, well, everyone's coming into the space, which gives us the confidence to keep working on it.
And I want to ask you about sort of the creator ecosystem on Snap. This is a group that you're very well in touch with. How do creators think of the Snapchat platform right now? Is it cool, or how's it doing with young people?
Yeah, I mean, I think for creators, you just really have to go all in on the platform. So the creators who are making, we interviewed one creator in the story. She's made $2.5 million over the past 3 years, but she posts 100 stories a day on Snapchat. So the creators who are seeing success and huge earnings there really have to go all in on the platform. I think in general, Snapchat remains very popular with Gen Z. There is some concern inside the company, though, about capturing future generations, because we've had this aging out effect with Snapchat that after a certain age, people stop using the app. So that's why it's so important for them to then capture the next generation. And there is some concern within the company that, Gen Alpha so far is not adopting Snapchat at the same, cadence of using it every day as Gen Z. Obviously, we'll see the earliest members of Gen Alpha are 1 year old. So obviously they're not on Snapchat yet. But, the 13 to 15-year-olds, at least so far, there is some concern within the company. So that's something to watch.
Martin, last question for you. Let's put aside the fact that apparently there's at least one person that is posting 100 Snap stories a day. Let's say Evan takes your advice. He decides to take the company private. What should he do with the company then? What should he focus on? How should he grow the company?
Look, I think the real issue is that Evan is delusional. Evan to think that because all these other companies are moving into the space is vindication of his strategy is crazy. I mean, Snap in the past 11 years has spent the same amount that Meta spends every quarter on AR. He does not have a hope of competing. He is competing with, much bigger companies that have much more resources. He should just give up.
Okay. All right. Well, Evan, if you're watching the show, come on the show and, we'll add you to this conversation. We'll have Kaya, we'll have Martin, and we'll have Evan. And then Martin, you can you can give him some of your thoughts face to face. Anyway, thank you so much for coming on. That is Martin Peers, our co-executive editor, and Kaya Yurieff, who covers the creator economy here at The Information. Okay, we all know about how OpenAI and Google are rivals in the AI race, but a new story from my colleagues this week revealed how OpenAI is actually relying on Google for the hordes of search data that Google is sitting on. I want to bring on Stephanie Palazzolo to tell us more about that story. Stephanie, how you doing? It's great to have you here. Oh, we just lost your audio. Give it to us one more time.
I'm great. Thanks for having me.
Stephanie was on mute. It's a Friday. It's okay. We're here to have some fun. We're talking about OpenAI and about Google search data. Stephanie, tell us what you found in your reporting.
Yeah, so in the story that some of our colleagues and me published yesterday, we reported that OpenAI is actually using data from Google Search and some of its ChatGPT responses. So specifically, they're using data from a third-party provider called SERP API, which scrapes Google search results. And we found that, OpenAI typically uses this data when ChatGPT users ask questions that require really, up-to-date information. So questions about news events or market movements, results of, sports matches, things like that.
So this is OpenAI finding its way to Google search data through this company SERP API. I want to talk about the bigger picture here, but SERP API is not a company that I have heard of before. What do we know about this company?
Yeah, honestly, not much. It's a quite under the radar company. So it was founded in 2017. It's based out of Austin, but it's actually never raised outside funding from investors, and it's kept a pretty low profile. However, from talking to different developers and people working on apps that require up to date search results, it seems like quite a popular choice for them because it is relatively cheap and. Our reporting also showed that SERP API has it's either currently listing or has listed in the past companies like Apple, Meta, and Perplexity as customers.
So it's doing it's not just OpenAI. It's doing this for a lot of these companies, really.
Yeah. It seems like there's quite a number of either big companies or other pretty high profile startups like Perplexity that are using them as well.
And so I imagine Google knew about this before you wrote this story. I'm sure this is something that they're watching. But have they said anything about this behind the scenes? Are they trying to stop this from happening at all?
Yeah, so it's pretty interesting. Behind the scenes, we have found that Google executives are aware of this. They are talking about this and trying to implement ways to make it harder for SERP API to scrape Google search results. But the interesting thing is that they haven't really taken any serious legal action against them to kind of shut down SERP API. And so kind of our hypothesis for why this might be is because Google's already, facing a lot of scrutiny for, having a monopoly over the search market in the ongoing antitrust case. And so the judge in this case is actually said that he might support Google sharing its search results data with other rivals. And so I think right now Google is probably not trying to draw unwanted attention to itself and probably not trying to seem like a bully by taking down SERP API or other companies that might be wanting to use Google search data.
I kind of want to back up a bit. I mean, OpenAI, Perplexity, some of these are all the newer sort of search companies that people like me, I use them all the time. We all use them all the time. But how hard would it be for OpenAI to replicate, for example, the Google search technology that Google has built so well?
Yeah, I mean, it is very difficult to replicate what Google has built over many, many years. And OpenAI execs have basically said that too. So we saw in the Google case earlier this year, Nick Turley, who's actually the head of product for ChatGPT, basically just came out and straight up admitted hey, we're aiming to answer 80% of questions with our own search index, but even that is a very lofty goal that we're not close to. And he basically said, being able to answer 100% of questions with our own search index is possible in the long term, but it's so far off and so uncertain that like we're just not even going to plan for that being a possibility right now.
And do you have any color on like why it's literally that hard?
Yeah. So the issue is that there's a really kind of, I guess, long tail of questions that people ask that are quite uncommon or rare. And so it's possible that, OpenAI and ChatGPT can prepare for the more common questions people ask. But, they always get questions every single day that the search index might not be prepared for. And then that's the second part is that it's also really important for them to have up-to-date information for when people ask about, again, like the results of sports matches or like real-time election results. And that type of data is something that Google is really good at getting quickly and indexing quickly. And it's very difficult for newcomers like OpenAI and Perplexity to be able to get that working well.
The thing that's really stood out to me in the last 24 hours especially is between this story and then also the story that we published about Google Cloud getting a $10 billion cloud deal with Meta. I mean, Google is really, I think at one point, they were sort of considered behind the 8 ball on AI, but it's really emerged as like central to the data side of the story, the cloud side of the story. Obviously, I mean, Gemini, the model is doing quite well against some of the other models. I mean, Google seems like it's having a good quarter, I guess you could say.
Yeah, definitely. No, I think things have really changed from, about a year ago when, as you said, the narrative was really Google's falling behind. We've written a lot about how the Gemini models are quite popular. And even though, companies like OpenAI would love a piece of Google's pie and they're really trying to challenge them, I think the story just goes to show that, like, you really can't beat being around for years and years and having that experience and that distribution. Because now we see that OpenAI is still dependent on Google for both search data and also compute, for instance, as well. And I know you just mentioned Meta as well, is competing against Google, but it's also just signed a giant contract for their services too.
Great. Well, Stephanie, thank you for coming on this show to tell us about that story. That is Stephanie Palazzolo, who covers AI at The Information. Our next guest, Josh Wolfe, has looked around many corners in his role as managing partner of Lux Capital. He was one of the first investors in Ader and has been investing in many of AI's biggest startups. He is also a close watcher of the venture capital industry itself and thinks that it is poised for significant structural change. Josh shared his latest quarterly LP letter this week and dropped some contrarian takes, and we want to play a special conversation for you that our editor-in-chief Jessica Lessin had with him to discuss all of that. Here is our conversation with Josh Wolfe.
Thank you, Akash. Well, I'm excited to be joined today by Josh Wolfe, the managing partner of Lux Capital. Josh, thanks for being on TITV.
Always good to see you. How you doing?
I am great. And I saw you've been busy. It's LP letter writing season over at Lux Capital, and you've released kind of your latest thoughts on the overall investing market this week, tech investing. So give us your hot takes.
Hot takes. Yeah, we come quarterly letters to our LPs. We take a lot of pride in authorship and writing it. And I basically consume copious amounts of coffee and chocolate. And then I've got some great partners that edit me down. And
how much ChatGPT is in there? Give us the real.
Zero AI. I've been writing these for 15 plus years. And basically abscond myself in caffeine and legal drugs and coffee and chocolate and just riff on all kinds of themes. The main theme of this one we called Friction's Frontier. And it's sort of the idea of the virtue and the vice of friction. Obviously in physical systems, it's like the great thief of all efficiency. And you think, particularly in technology, move fast, break things, that you want low friction. You want basically like the lubricants and the ball bearings that let you just like move at rapid speed. But there's a lot of systems where you actually do want these sort of fail safes, in nuclear reactors, runaway chain reactions. And so there actually is a virtue of certain frictions in systems. And if you can identify those as an investor and basically accept like, okay, there's certain things that are not going to be movable. And then on the flip side, there are bottlenecks that can be broken. And you want to basically fund the entrepreneurs, that are developing those.
Why this moment? And what are the frictions that you're looking for, that you're sensing in the system? Because it actually feels like everything's moving at rapid speed. So.
It is. So, the answer to the first part, if you think about like AI and chip design, AI in seconds or minutes can design a pretty sophisticated base layer for semiconductors and, new chips. But TSMC's fabs and the EUV machines still move in geological time. They move at the pace of physics, and you can't actually catalyze and speed that up more. Same sort of thing, like you can conjure a design for a new home and an architectural blueprint, but concrete is still going to basically, dry on its own time frame, and you can't really accelerate that. So it's that balance of looking at what are the things that are basically immovable and you have to be realistic about, with the things that sort of can be accelerated. To your point on time, I have this quote that Einstein said that the reason that time exists is so that everything doesn't happen all at once. And it is so easy in sort of the slipstream of modern information flow to just feel that. And it feels observable. You look at geopolitics and war in the Mideast, in Russia, in Ukraine, in Africa. You look at domestic political chaos. You look at the horseshoe theory of the far left and the far right. You look at the populist movement and the nationalist movement and the sort of illiberal order. There's just like this stream of chaos. And to us, the friction there is to actually slow down. And the thing that you actually want to slow down, and it's sort of the conflict of where you spend it, is your most important resource. Notably, it was the title of one of the great AI papers that ushered in the transformer, which was "Attention is all you need." But where do you put your attention? Do you put it on the 5-hour issue that's happening because everybody's buzzing about something on Twitter or social media and the news, or do you put it on the 5-year time horizon? And as investors, I always say that there's this 5-year psychological bias that everybody wants to be invested today where they should have been 5 years ago. And the raison d'etre of us and all other VCs is to try to anticipate today, where are people going to want to be in 3, 4, 5 years, so that you can be there first. So that's a big theme. Within AI, every facet, right, is today this like slipstream of chaos. Probably nothing more than, and you guys have covered this phenomenally well with the information over the past 2-3 months, but particularly with Zuck, what we've dubbed the poachapalooza.
Poachapalooza. I haven't heard that one. I love it.
But literally, it's just the trades that are happening and the dollar values of people is insane. And the great irony, of course, is that what's being acquired is not artificial intelligence. It's not hardware. It's not contracts. It's human intelligence. Two-legged mammals. It's people. And so there's a poetic irony in all that.
So if you apply your framework, where do you want to make your big bets over the next couple months? I think you wrote in the letter you've deployed $500 million of capital just in the last couple months in more than 80 new and existing companies. So it sounds like the pace is there. What is on the intriguing list and what's on the not intriguing list?
Not intriguing is a lot of two-dimensional AI. So I think everything there is relatively saturated. We had a debate early on between closed source and open source, but everything that's been done in like video, images, text, audio, you have runaway leaders. You have compounding competitive advantage from a lot of those companies.
And what's two-dimensional AI is like?
Stuff coming off your screen.
Oh, sorry. Say that again.
Like stuff coming off your screen. Like
okay.
Text, images, video, sound waves. 3-dimensional AI, if you want to call it that, or the physical world, particularly robotics and biology. And the reason that that's valuable is that there's a scarcity, and whenever something is scarce, it becomes valuable. And the scarce thing in those domains is lots of unstructured data. A robot walking into this room and deciding how much force to use to lift my bottle, my drink, is totally different than the intuitive grasp that a 3-year-old might have. And there is no repository of information from Reddit and Twitter and the Library of Congress and all the internet to train models on. So the people that are developing that unstructured data for robotics, I think, are quite valuable. We've got an investment with Lockheed Groom and Carol and team at Physical Intelligence. So bullish on that. We've been putting a lot of money in there. Same thing on biology. Lots of unstructured data. It's not the stuff where people are doing protein folding and trying to understand, but truly, how do you do like as an evolutionary scale, which we actually spun out from Meta because they sort of decided to shut this entity down.
Right.
It's really them and isomorphic as the two leads in the cutting edge of foundation models for biology. The third area within AI that I think is pretty interesting is memory. And I don't mean memory as in the models that we're using that Claude and ChatGPT and et cetera, remember our prompts and have context, but specifically the hardware in the devices. And my speculative thesis is that like 50% of the inference that we will do, contrary to what Jensen and NVIDIA would like you to believe, which is that you need hundreds of thousands of H100s in the cloud.
Yep.
You do need that for training, but I believe that you're going to see increasingly on-device inference, and that the hardware that is going to power that are going to be edge inference chips, novel FPGAs, and particularly flash memory. There was a paper that Apple put out that not a lot of people had read a year, maybe 15 months ago, and it was the spark for me to say, wait a second, SK Hynix and Micron and Samsung that people consider to be sort of commodity flash memory or SRAM or DRAM players. It's the same thing that people thought about NVIDIA back in 2015 or 2016. Oh, these are just commodity gaming chips with the cyclicality of a PlayStation or an Xbox. But all of a sudden, no, it became the soul of the new machine. So if your emails, health data, I just posted on Twitter today an interesting Apple paper, coincidentally, about the health data from watches and new foundation model that's competing with transformers to unearth insights. I think that these edge inference devices are going to become a big deal. It'll take 2 or 3 years.
It's a pro-Apple thesis, if I heard one. I mean, I think it's a good, whatever NVIDIA's market cap is today, it's that $1 trillion question too, right? I mean, they're really banking that generation of hardware is going to continue to be as dominant. But that seems very uncertain to me. So that's an exciting area. What about, Josh, you had some predictions about the firms themselves. And it's just kind of been a wild time in venture, and I look at the GPs moving and contracting and, in our wonky world at the information, this is like big news for us. But you had some predictions around firms going out of business and also firms going public. Can you talk more about that?
Yeah, so not quite poachapalooza on AI talent, but the flow of human capital. Remember, venture businesses are partnerships, right? And some of those partnerships become institutions. I've called it the minnows and the megas. The former, the minnows, are the very large number of very small funds, meaning sub $100 million size and scale, and maybe sub 500 million today. But they were the thing du jour for a good 10 years, and for good reason. LPs looked and said, hey, solo GP, micro VCs, early access. Why? Many people had a roommate, a friend, a former coworker. They had early access and entree to be founding investors in something. And with the large number of growth investors and follow-on capital that were providing high valuations, low cost of capital, they were all doing great. All of a sudden, many of the areas that they were in, enterprise SaaS, software, et cetera, some consumer out of favor, a pivot into hard tech and AI and hardware and deep tech and aerospace and defense, they can't compete because these do require large amounts of capital. And so I was with an LP maybe 3 months ago, and I remember sharing this thesis, and they were a large LP of ours, and I said, I think you're going to have a 50% extinction rate amongst this class, sort of like what you did in the post.com boom bust. And he said, Josh, that's ridiculous. It's going to be 90%.
Wow.
So I do think that the involuntary exits of the minnows, the small funds, is going to be high.
Yeah.
The flip side,
hasn't it? I mean, I feel like I'm running less into. I mean, you mentioned and he's a rock star in the space, but you mentioned Lockie Groom, who was a solo GP and now is digging into founding a company again. And I just think I observed that, and that isn't because Lockie couldn't raise money. I'm sure he could, but right, like being pulled back.
Totally. And Lockie's a great investor, and he'll continue to invest on the side for sure. But I do think that you will see, and again, it isn't meaning all of them, and there's going to be some small new entrants that have come in the past 2-3 years, and we're friends with some of them, and they're going to build great firms. But just in aggregate, you're going to see a involuntary exit and extinction of these firms. The flip side, voluntary exit. What I mean by this when we were writing it here is the megas. Now, the megas started, go back a decade.
The A16Z IPO, because one of these days we're going to be right about that.
No, look, these are amazing firms with amazing people, and we love partnering with them. What's happening is, I would say there's 5 or 6 firms that are following the 2009 to 2014 playbook. And you can see it by some of the people that they're hiring with the skill sets for SEC, regulatory, IPO, capital market facing. But you can also see it with their activity, not in the investments that they're making, but in the acquisitions of entities globally, or the expansion of products, new fund strategies, et cetera. So I think the 5 or 6 that are likely to end up going public, like the private equity guys did 15 years ago, which are Apollo, Blackstone, Carlyle, TPG, et cetera, are going to be Andreessen, General Catalyst, General Atlantic, maybe Insight, maybe Lightspeed, all approaching 100 billion AUM, diversified product platforms, credit, wealth management, early stage, late stage, lots of different funds. Starting to market, you can see it at airports and on airplanes,
totally.
In podcasts and whatnot, to the retail audience, building that familiarity. and they will effectively do that. I don't think it's a
They
bad
have
thing.
to do that. So
No.
this isn't driven by the thirst for new LP capital.
No, I
They could
think
do a
in fact
$60 billion deal with the Saudis and be done.
Yeah, I think it will actually sort of conversely change the quality of the LPs per se. I don't think a lot of the sophisticated endowments or the people that are very sought after as like high quality LPs will want to be part of that strategy per se. But I think that it will democratize access in a good way. Probably, you look at the president's executive order. It's going to be some time, but in the same way that ERISA changed in the 70s and ultimately 80s with a huge flood of retirement money, now that 401ks might come into that. You see private equity already leading the charge in going more and more retail. I think that this is going to be basically a capture for a huge amount of global retail money, but it will change the quality of the LPs that want to be invested and the quality of the founders that want to take that money.
Yeah.
Would you rather have Fidelity as an investor, sort of passive indexing in a large scale, or would you rather have, Stan Druckenmiller as your investor or something on the public markets, right?
Yeah.
And so there's going to be a
I think
distinction.
Mark's going to bristle with you comparing him to Fidelity eventually, but we'll see.
I'm not saying they are. I'm just saying
It's of course it changes, and that seems to carve out a good lane for the funds like you guys and others. Josh, before you popped out of a meeting to join us, so I'm very grateful. I'll let you pop back. One other trend I've just been watching is obviously the U.S.-China investment flow, and you've been a strong proponent of the fact that saying U.S. investors should not be, bolstering China tech companies, so on and so forth. What it seems like in just the recent days, there's been a little more activity of some U.S. firms making investments, poking around investments. We saw a bunch of U.S. investors in Manus, obviously a Chinese AI company with a lot of momentum. But has there been a shift at all, and where do you still stand on it?
I do think that there are some contrarian sentiments about the is and ought, meaning that they believe that, as I do, there ought to be free-flowing capital between U.S. China. There's brilliant people there, 3x the size of the United States, and just extraordinary. It would be great if you did not have the leadership of the CCP. But yes, Benchmark and a handful of other people have made investments. I was wrongly critical, in particular, of the Manus deal because I don't think I knew enough at the time and sort of reacted superficially to the headline. Bill Gurley is a good friend, and I respect him and the partnership a lot. That team seems to have been ported out of China, into Singapore and elsewhere. And I think you're going to have a bunch of folks like that. That said, I think there are also a lot of funds that were investing in China, 10, 12 years ago when they had been led to believe this was going to be a great market and all, but they didn't realize that the Chinese Communist Party had this military civil fusion, that everything was aligned, sort of with antagonism ultimately towards the US. I think if they knew today or knew then what they knew today, they wouldn't be making those investments. So I think it is questionable if you're funding something that, as I said in testimony to Congress, they've got a belt and road strategy. It's one thing to have the belt and road strategy. It's another thing to give them the belt to put around our neck and use against us. And so that's where I think if you're involved in something and everything goes to the party, that's in AI, in aerospace, in defense, in materials, in critical minerals, in infrastructure, hardware, even biotech, you're really playing with fire. And I just think it's unwise to be investing in an adversary until there's regime change, which may take a generation or longer. I just think there's so much rich stuff to invest in the US and Israel and the UK and Europe and other places that you just don't need to be investing there.
Yeah. Oh, before I let you go, how's Anduril doing? You're one of the largest investors. And it's just I feel like that's a company we're going to wake up and in a year or two, it's going to be public and large, and we'll be talking even more about it. But
I just feel very lucky to be part of it. We were day one investors really because of Trey Stevens at Founders Fund and a deep belief in Palmer Luckey and the idea that chips on shoulders put chips in pockets. It has performed extraordinarily between organic growth and acquisitions, and they're going to continue to do a lot more of both. And I think we'll see a public company within a year or two. And I remember being at the Reagan National Defense Forum with Peter Thiel in 2019, and people were like laughing at Palmer Luckey. And it's a classic Gandhi thing. First they laugh at you, and then they fight you, and then they join you, and then you win. And it's what's happening. And they are winning. And I'm just proud to be part of it.
I got to say, I had the opportunity to meet Brian, the CEO, for the first time. I know Palmer obviously gets a lot of the media attention, but it was a really interesting conversation I had with Brian. Unfortunately, off the record, so I can't share it with our viewers, but made me more intrigued about the company and interested in the next 12 months. Well, Josh, get back to your meeting. Thank you so much for joining us.
Great to see you.
Back to you, Akash.
See you soon.
That was Josh Wolfe with Jessica Lessin. Okay, software earnings season is upon us. Zoom reported earnings last night. Next week, we've got Snowflake. The week after, we've got Salesforce. Somewhere in the middle of that, a bunch of cybersecurity companies will also report. I want to bring on two people who follow this sector very closely to give us a preview of what to expect and also what they're watching for. Jackson Ader is a managing director at KeyBank, where he runs software equity research. Anita Ramaswamy is our financial analysis columnist. Welcome to you both. It's great to have you here. Jackson, I want to start with you. You put out a note this morning that said, quote, earnings headlines have looked strong, but looks can be deceiving. What did you mean by that?
That's right. Thanks for having me, Akash. So yeah, the looks can be deceiving in two ways for this earnings season for software stocks. Number one is foreign exchange. The weakening dollar and strengthening euro is a good thing for U.S. reporters. And so that's certainly a tailwind on the reported basis, right? The headline basis.
Right.
And then the other thing is, if we think back to April, May, when these companies actually were providing guidance for the upcoming quarter, we were a lot more nervous. We being software in general, were a lot more nervous about how second quarter bookings would be. And so there was maybe some extra caution put into the second quarter results.
Okay.
And so between caution and foreign exchange, you get a lot of upside to revenue that might not totally be just broad-based demand strength.
Got it. Okay, so the guidance may have been a bit lower, and the foreign exchange might be a bit of a benefit here. Talk to me about, look, Snowflake and Salesforce are the companies that we at The Information totally geek out about, and we get almost excited that earnings are coming up for these two companies. They feel like bellwethers for the software sector. What are you watching for each of those two companies? Let's go there.
Sure. So my friend and colleague Eric Heath, he's the one who's on Snowflake for us here at KeyBank. Snowflake is I would say one of, if not the most important consumption software names, right? This is you can draw a pretty stark contrast between consumption software that's based on maybe the amount of data ingested or volumes versus software companies like most applications that are seat-based. And so Snowflake, I think Eric is pretty positive heading into earnings next week, but you're absolutely right that it is a bellwether for consumption. And if artificial intelligence, cloud data storage, and just the move from on-premise workloads into the cloud, whether that's because of AI or because of just regular way SaaS, that should continue to help Snowflake's business. As we think about Salesforce.com the following week, our conversations in the ecosystem are fun, right? I think partners are generally positive. Agentforce continues to be the number one topic of conversation for Salesforce salespeople and for partners. We put out a note just recently, thinking about how we actually get to $1 billion in Agentforce contribution. It's not all that difficult as long as once these pilot programs end, customers keep paying for and using Agentforce.
But that's a big if, right? I mean, this idea that they'll actually renew. I mean, this is the whole thing about experimental budgets, I guess.
Oh, for sure. I mean, if you're talking about a pilot program that is, a nominal amount for most of Salesforce's enterprise customers, $25,000 or so.
Yeah.
And then you're thinking about, okay, we're going to turn this on. And if users actually like the pilot program, $25,000 could possibly be the spend for a single employee.
Right.
Based on the number of actions and conversations. So it's going to be a big leap between $25,000 and north of $1 million for plenty of these installations of the Agentforce.
Right.
And to be honest, I mean, that's why I said it at the start. It's slowly building,
right?
Because it's just such a step up in what you're actually going to have to pay.
Anita, Databricks is the private software giant that doesn't report earnings, of course, and they made news this week with their $100 billion valuation. The the Databricks Snowflake rivalry is one that I think we all like to watch. Can you just walk us through what the state of that rivalry is? I mean, Snowflake is technically it's a smaller company, I guess, by market cap now, right?
Yeah, it's pretty wild. The market cap is around 65 billion versus Databricks raising at $100 billion valuation, as they said this week. And it's been a bitter rivalry from the very start. You know, the two companies kind of have their conferences during the same week to talk to their customers. The CEOs are sometimes taking barbs at each other. They both did competing acquisitions last year around the same time frame. So it's been a really fun one to watch. And it's interesting because Databricks raised at this, or it is raising at this big valuation, which is around 27 times their annualized revenue that they most recently reported. And Snowflake, meantime, is trading around 13 or 14 times next year's sales. They're not directly comparable figures. We're looking at different revenue time periods, but you can see that Snowflake is getting a significant discount. I thought it was really interesting that we saw a tweet from the Snowflake CEO, Sridhar Ramaswamy, kind of calling out Databricks and their valuation. And he was saying that private company valuations are often negotiated behind closed doors, and was sort of suggesting that Databricks might be inflating their number. There are some real business results that we've been seeing from Databricks, like they've managed to strike this partnership with Palantir, which has historically been seen as sort of a third competitor to both Snowflake and Databricks. And Databricks is saying that they expect to grow faster. Their current growth projection for revenue is around 50%. Snowflake's is closer to the 20 to 25% ballpark.
Right.
And so Databricks has seen a lot of success, but there are also questions because they're a private company as to how we can really cross-compare those numbers.
Right. Anita, I want to pivot slightly and talk about a story that you put out this morning, which was the wonderful metric of net revenue retention, which we're going to get in the weeds here. We're going to try to keep it above water, though. So net revenue retention, tell us in 20 seconds what the gist of your story was, what you were trying to get at with that column.
Yeah, so there's a metric in software that a lot of investors have been looking at, and it got a lot of attention, especially during the Figma IPO, called net revenue retention. And this metric essentially looks at how successful a company is at upselling its existing customers. So once you account for all customers that leave, customers that churn over a 1 or 2 year period, how much is the company able to actually increase its sales from the same existing customer base?
And so, okay, they have this metric, and there are ways to juice that metric, essentially, right?
Yeah, it's not a standard financial metric. There are no real rules or regulations as to how a company can calculate or report it. So even though it's called similar things at all these different software firms, it's calculated really differently. Some companies use their annualized recurring revenue to calculate it. Some companies use a different revenue metric called annual contract value.
Right.
And even within that, you can look at different timeframes to smooth out volatility. A lot of companies actually report on a threshold basis, which means they'll just give you a ballpark or a range for what the metric is. And that means you can't really see some fluctuations over time. And I think one of the most interesting examples was actually Figma. They had, when they came out with their IPO, they reported one of the highest, if not the highest, net revenue retention metric in all of software, around 132%.
But then they had that disclosure in the filing that this is only for $10,000 or more contracts, right?
Exactly. So if you can sort of select and cherry pick your customer cohort, it's not really a comparable number to the ones that other companies are reporting. So Figma got a lot of credit for that, but at the end of the day, you have to really dig deep and look at what are the differences and how these companies are defining that metric.
So Jackson, when you get that figure then from public companies, then what do you do with that? I mean, this number could mean anything, really.
First of all, thank you so much for that article, Anita. This is absolute catnip for me. So first, when you get net retention rate or net expansion rate, whatever people call it, you must check a couple of key things. Number one is exactly what Anita just said about who's included in that net revenue retention rate. Most of the time, software companies are going to exclude the low end or the people that churn off a bunch of their platform so that metric looks better. Whether that's, at $100,000 customers or Figma 10,000 or, a certain number of employees, you have to check what cohort is actually being analyzed in that particular metric. And then the other thing is, a lot of companies do not report what I would call the real-time net retention rate. They report a trailing 12-month retention rate. And that benefited a lot of software companies on the way down because you were capturing, it's a barge instead of a speedboat when you do it on trailing 12-month revenue or trailing 12-month ARR. And so if your growth is slowing,
Just simplify that for what do you mean by that?
so instead of saying how much revenue did we make this quarter and how much revenue did those same customers give us 1 year ago, we might say, all right, how much revenue did we generate from these customers over the last 4 quarters? And how does that compare between how much revenue they gave us over the last 5 to 8 prior quarters, right? So you're looking way back in some of these metrics on a trailing 12-month basis, which smooths out that metric. It makes your net retention rate look a lot more stable than it actually is in quote unquote real time if you were just looking at a year over year basis. So again, when things are slowing, your net retention rate will slow not nearly as much as the underlying growth rate of the underlying net retention rate of your business.
Right. Well, it's a good reason to, again, take all those numbers that companies give you with many grains of salt. The last question I want to ask you both really quickly before we let you go is, look, there has been this fear that AI will eventually start to affect enterprise software earnings. And that's something that we seem to be watching every quarter. How do they mention it? Did it impact things at all? Jackson, are we seeing that at all? And do you expect to see that in the next 2 weeks at all with respect to companies saying, look, AI is taking a bite out of our revenue?
No, I don't expect that. Certainly not in the next couple of weeks. Where we have seen it impact SaaS reporters thus far has been on search engine optimization, not necessarily the fear that AI is displacing them from like a competitive landscape perspective or reducing the number of seats. Don't expect anything in the next couple of weeks. And in fact, I would expect some analyst days in the fall and maybe even preliminary kind of 2026 guidance to be a nice reassuring message from software companies that it's like, oh,
we're doing okay. We're doing okay.
Yeah.
Anita, have you seen anything in results last 2 weeks to that effect?
I mean, I just think if you look at year-to-date performance, forget even just the last 2 weeks, you look at this huge divergence. We've seen Salesforce stock is up about 25%, or down about 25%, while Snowflake stock is up about the same amount. And I think it just gets to the difference between how people are looking at the infrastructure underlying some of these AI applications versus the applications themselves, with Salesforce being in that app category and Snowflake being perceived as more in the infrastructure category. So I'm going to be really curious to see if that divergence continues and gets bigger.
Got it. Well, Jackson and Anita, thank you so much for coming on the show and walking us through what you're looking for in the next 2 weeks. It was a great discussion, and maybe we'll have you both on again 2 weeks from now, and we can sort of debrief how things actually went, because who knows, the story could be very different. That is Jackson from KeyBank and Anita from The Information. Well, that does it for today's show. A reminder, we are live on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank Amazon Web Services, who is our presenting sponsor for this production. And I want to thank you for tuning in. We really do appreciate your viewership. I am already excited for our next show on Monday. And so until then, have a great weekend.